Hello and welcome to today's discussion with Rubini Global Economics. I am Christian Menegatti, Head of Global Economic Research, and today we have with us Megan Greene, our Senior Economist for the eurozone. Hi Megan.
Hi.
And welcome. Thanks for your visit to the New York office today. So we just published our outlook this week, and we had our outlook call. And I thought that some of the most interesting risks and questions that were mentioned, of course, have to do with high oil prices at this point in time. The risks that the U.S. going forward or U.S. macroeconomic data going forward might surprise on the downside. A Chinese slowdown that is already with us and quite visible in the data. And then the last risk is still there, the eurozone, right? Which is your area of expertise, of course. And what I wanted to start asking you is, in the last few months, of course, courtesy of the long-term refinancing operations of the ECB, seems that markets have calmed down, and the eurozone seems to be at least a little bit less in the headlines than what it was before. So, have the risks subsided?
Yeah, that's right. I mean, the Eurozone crisis has really abated since the ECB announced these LTRO operations. But, nothing fundamentally has actually changed. So we have seen a lull, but we don't think that it will last forever. And there are a number of potential triggers up ahead. One is very soon, actually. Spain is announcing its 2012 budget on Friday. And so we'll see what measures are involved.
Deficit was a Freudian lapse.
Yeah, that's right, exactly. And they've already agreed to a deficit of 5.3% of GDP, but we'll see what that's made up of. And Spain has had a lot of ink spilled on it recently. Previously, investors had been more worried about Italy, but all of a sudden the yields have flipped and investors are more worried about Spain now. And I think that that's probably right. Spain looks fundamentally worse than Italy. So there is a lot of attention on Spain, and there are some worries there, certainly. Moving on beyond Spain, we've got the French elections coming up. Really, I think that the impact of the French elections on the Eurozone crisis is probably overdone in the media. So even if there's an Hollande victory, I don't think that will make a fundamental difference in the Eurozone crisis. But on the theme of elections, the Italian elections are only a year away. Recently, some worrisome data has come out in opinion polls in Italy. Monti seems to be losing favor now that he's announced these more difficult labor reforms. And so even if Monti does manage to actually implement them in the next year, the next government might not continue along with his aggressive structural reform program.
Right. So you covered a lot of ground right there. And why don't we start with some of the triggers that, in your view, could actually, bring this crisis back, bring volatility back, bring spreads to widen again. So I think there's two questions here that people are interested in at this point, right? One is the Spain versus Italy question. Recently, Spain became more risky. If you look at the spreads, at the 10-year spreads, more risky than Italy. Is that justified in your view, especially in the view that everything was running very smoothly? Monti actually had a very strong rate of approval. He managed to push through parliaments lots of reform. Now that we're getting to labor market reforms, that seems to be the real test. So we have a country that has a huge stock of debt, perhaps better flows, and now the test is going to be labor market reforms. And then we have another country that has much worse fiscal numbers, right, in terms of deficit, perhaps a smaller stock of debt, which might actually get a little bit worse. So how do we think about the Spain versus Italy comparison, and what could be triggers that we should watch going forward?
Yeah, right. I think you're right to kind of separate out the stock of debt versus flows of debt. And I think on that front, Spain looks a lot worse. Of course, one of the things you need to consider when looking at flows of debt is competitiveness, but also growth. And in terms of growth potential, Italy is much better off than Spain. There's a lot of wealth in Italy. Italy has a huge manufacturing center. Spain doesn't enjoy that, and Spain has far more severe rigidities in its labor market even than Italy. And the government's taken a few measures to address that, but I don't think that the measures have gone far enough. So I think the adjustment that Spain will need to make to find sustainable growth is even larger than that of Italy. So in my view, Spain looks worse off also if you consider the banking sector. Spain's property market has fallen about 23%. It hasn't come nowhere near to finding a floor yet. And so as unemployment continues to soar, it's almost 25% now in Spain. And as you see property prices continue to fall, we're going to see mortgage defaults crystallize, and that will undermine the banking sector. So Spain still has this kind of unknown black hole in its banking sector that's very worrisome as well.
So our baseline, if I read correctly our scenario analysis, right, our baseline is essentially still Greece eventually, or at least at the end of 2013, after possible elections and probably well into the new program, eventually exiting the eurozone. Right, that's a case of insolvency that we don't see being resolved by liquidity or by actually piling up more debt, even in the face of restructuring, right? So that's one issue that eventually we're going to have to be confronted with. But then the big elephants in the room are still Spain and Italy, right? So how far in the future could this problem be pushed at this point in time?
So I think some time has been bought with the ECB's LTROs, right? And I think at least a year of time has been bought. We've seen that yields for both Spain and Italy have been suppressed as a result of these operations, and that will continue to be the case. But eventually, the LTROs will be undermined, I think, by real hard facts on the ground. And we saw this to some degree last week. The PMI data came out of the eurozone, and all of a sudden, everyone was really worried about Spain again. Right. I think the economic indicators will look appalling for Spain and Italy over the next year, if not 2 years, and so that will undermine the kind of temporary confidence that investors have had in both countries.
So you're still very worried about a possible debt restructuring in Spain and Italy?
That's right. I think a bailout package could be put together, cobbling together EU bailout funds and IMF funds for Spain and Italy, and that will buy some more time. But ultimately, the kinds of structural reforms that Spain and Italy are having to implement will take a very long time to bite and support growth. And so I don't think that they'll manage to buy enough time for Spain and Italy. And therefore, I think we'll see a debt restructuring in both countries.
Well, that would be quite disruptive, I would say, for global growth in general, right? Especially if, at this point in time, we have a scenario in which we're looking at China to possibly face not necessarily a hard landing, but a significant slowdown via slow grind. That's how we call that scenario between 2013 and 2015-16, right? So not before this leadership transition that is taking place, right? So having China facing a significant slowdown that is going to affect global growth, given the share of China in the global economy, having the eurozone at the very same time having to go through a possible restructuring of a huge pile of debt, right? Italy being the third largest bond market in the world, and Spain going in that direction, essentially, right? That could be extremely disruptive for global growth at this point in time, right? Last year in October we were calling for a U.S. recession, and part of the reasons why we were still thinking about a possible U.S. recession were credit conditions across the eurozone, which of course will become again extremely tight, probably back to last October's level or even worse than that, and that could definitely have a global effect on credit conditions, on real economic growth, and tip us again back into a global recession, 2008, 2009 style.
Yeah. What do we think about the U.S.? Because if we look at all the major economies in the world, it does seem like the U.S. might outperform. Do you think that that's right?
Yeah, I mean, the U.S. is clearly doing better, especially in relative terms with respect to the eurozone, right? Maybe not better than most advanced economies. Some advanced economies might be doing better, especially driven by commodity prices. Other emerging markets, of course, have higher potential growth, so their macro it looks much better. But it's true, the U.S. has outperformed expectations, perhaps in Q4 and at the beginning of the year. At this point in time, we still see strength in labor markets. There are still several vulnerabilities ahead, and we remain worried about, again, some of the risks that we mentioned at the outset. We still should remain worried about what can happen in the eurozone, so that's one risk. We're very worried about oil prices, and not necessarily because we think that there's going to be a military intervention in the Middle East. That might not be our baseline scenario. We're not necessarily geopolitical experts to judge that, right? But nevertheless, the fear premium could rise from here, and oil prices already, with WTI potentially getting closer to 120 at a point, that will create significant demand destruction, and depending on how persistent the shock could be, that could create significant drag on GDP. We're also worried about more domestic sort of vulnerabilities that remain, right? The housing sector, that we've seen recent home prices for Q4 and even January and February continuing to slide at a pace of 4% per year. That, of course, while U.S. households are still in balance sheet repair mode, does not bode well for that process, of course, because the asset side is still remaining depressed, and negative wealth effects could still affect consumption. consumption. And then the other concern is a huge fiscal drag ahead, potentially. Again, that's not necessarily a guarantee, but clearly there are some programs that are due to expire at the end of the year. And if those are allowed to expire, potentially the fiscal drag could be larger than our present forecast for 2013. So we're not necessarily calling for a recession in 2013, but potentially there is a risk of falling back into stall speed. And that's also one of the reasons why we think that both domestic and external vulnerabilities call for another more easing on the monetary policy side. So we do think that there will be another quantitative easing package, and of course that's going to have not just implications for the U.S. economy, but possibly global implications in terms of liquidity flows. Well, if we were to see a QE3 package, potentially that could have an impact on the dollar, weakening the dollar, right? So how would do you think there would be a reaction on the side of the eurozone?
So I think it will have an impact. I don't think there will be a reaction in terms of the ECB stepping in and initiating some kind of similar QE procedure. I don't think we'll probably see that, but it would certainly impact Eurozone growth prospects. Especially given that the drivers right now in the Eurozone are the core countries like Germany and the Netherlands, which are very dependent on export growth. And so if you have a stronger euro, that will certainly hurt their growth prospects. No matter how you cut it, the periphery is going to look bad for the next few years from a growth perspective. But a weaker dollar will certainly have a negative effect on the Eurozone.
Okay. Okay, well, thanks, Megan. Maybe we can stop today's discussion here. Thanks a lot for your thoughts. You can find many more of our thoughts on Rubini.com, and looking forward to the next discussion.